Mortgage rates, how flippin' boring. I mean, honestly, who cares about interest rates? I mean, the only time you care about interest rates is if you're buying a house or refinancing, and then you got to figure it all out, and you really don't want to. A lot of stuff online now, especially when it comes to the 30-year, because everybody's chasing around 30-year money. 30-year money happens to be the most expensive money you could buy, by the way. I don't think any of you guys are going to be in any of these houses for 30 years, honestly. The very idea of being in the same mortgage for 30 years is absolutely ridiculous. But it is the easiest and the cheapest mortgage to get into generally. It doesn't have the lowest interest, first of all, which means it doesn't have the lowest payment. It is less riskier though, and that is the big thing. It's all about risk, right? Well, I can tell you, if you look at the Treasury Index and you understand indices are based on pools of money, right? Pools of money that are changing valuations. Well, the valuation can change by several different variables, but because the economy is continuing to grow, the ARMs will give you more buying power for less money. For instance, you may need you may be all settled on a 30-year, and all of a sudden you're getting into a property that's getting bid up by 100 or 200,000. Maybe not 200, maybe 100, 125, but you go in and you change your 30-year to a 7-1 ARM or 5-1 ARM and drop your interest rate down a point, and all of a sudden you've got $125,000 more buying power. Boom, that's what I'm talking about. It's not, it's not so black and white. There's a lot of gray. There's another company, CMG. I don't know if any of you guys have heard of CMG. CMG is so cool. What you do is you open a bank account, and the interest rate is accumulated or calculated based on your daily balance of that account. The account also has your mortgage balance on it. They don't take whatever's left at the end of the month. At the end of the month, you make your normal mortgage payment based on whatever interest rates there are, but the accumulated amount of interest over that 30 days isn't straightforward. It changes based on how much money you throw in that account. So theoretically, you could pay your house off in 3/4 of the time and not make any different payments than the 30-year, My point is, in terms of the ARMs, like a 5-1 ARM, for instance, it's fixed for 5 years. Well, what does the 1 mean? Well, the 1 means it's going to change the rate every year thereafter, after the 5-year fix. Then there's a cap. There's a cap on how much it could change when it becomes the changeable date. The changeable date will be the date of your first payment, when your first payment was calculated. So at that particular time, the index could be up or it could be down. If it's up, let's say 5 points, that doesn't mean your interest rate goes up 5%. It goes up no more than 1%. If you take a regular 30-year mortgage and you go into a 5-year ARM and you lower your payment by X amount of dollars and you take that difference and you apply it back to your mortgage, you're going to pull down the principal so heavy that you can actually absorb a change at the end of that term and it won't affect you at all because you've been pulling down that principal at an accelerated rate, because the 30-year mortgage, the first quarter of that mortgage hardly touches the principal at all. You're still at 96 or 97% of the original loan amount, 5 years into the loan. Just a little theory here, just kind of, throwing it out there. My name is Paul, Bluewater Properties. Feel free to call or text me. Thanks for listening.